Hi everybody, I'm Elizabeth Yu from the Xero Education team and welcome to Accounting 101, and we're so excited today to have Liz Mason from High Rock Accounting presenting a quick overview of all of the things about accounting that you want to keep in mind when you're just setting things up, or maybe you're just starting your business and you want to know what are the things that you do need to keep track of and what's maybe too much detail. But Liz is going to give all of this and more, including a quick overview on some of the other software that you might want to integrate as part of your overall accounting picture. So without further ado, I'm going to pass it on to Liz and she can introduce herself. Thanks, Liz.
Thanks, Elizabeth. I'm happy to be here today, and I love talking about accounting. So I'm going to tell you a little bit about me. I am an Uber nerd, and I love helping businesses grow. And so what I do with High Rock Accounting is focus on startups and new companies, and also growing companies, and we help them build custom ecosystems through systems and then make sure that they're able to grow their accounting functions and use that financial data to run their businesses. So I work with lots of startups, like I mentioned. I specialize in tech startups. Our firm focuses on lots of different industries, and we work with clients both domestically and internationally. My background is I am a CPA. I have about 10 years of experience with international firms, and I have degrees in accounting, finance, and information systems. And I think all of those things function together in today's day and age. So today we're going to cover a few awesome topics, and basically this is a really high level overview of what you should think about as a new company to set up your accounting. So what are the basic objectives? How do you identify what's important for your company and what you should be tracking? And what are the benefits of cloud-based accounting, and what does that mean? And what are integrations? What do I mean when I say ecosystem? A big question that I get from lots of new companies is payroll. How do you identify when to start payroll? Do you need a payroll company? Do you need an accountant to do payroll? What's an independent contractor versus an employee? And how does a company actually scale its accounting and get ready for that growth phase? Those are all things we'll talk about. So step one, badass accounting. All right, guys, we're done. That's it. That's all you need to know. Just do a badass job and you're good. I know, I'm kidding, but badass accounting starts with really good systems, in my opinion, and we'll go into that in a lot of detail. But first off, I'd like to say, I absolutely adore cloud-based systems for the efficiency and the access. You're able to access these systems from anywhere. You can create multiple users and have different people have different view levels so they can see things in the system. And it helps with efficiency and reporting. It's kind of a miracle when you can sit up your phone and say, oh, hey, this is what happened last week in my business. Let's take a look at it. So another thing that we need to talk about are definitions. And so, how do you set up a badass accounting system? First, you have to really understand what an accounting system is and what the basics are for accounting. So let's start with that. The first thing you'll probably hear is chart of accounts. And so a chart of accounts is effectively your account listing. And what that is, there's all the different buckets that you're going to classify items into. So it's your income, it's your expenses, it's your assets, and it's your liabilities. So then you take your chart of accounts and you create what's called a trial balance. And a trial balance is your chart of accounts with actual dollar amounts assigned to each account at a specific point in time. Now, all of that is tracked in what's called a general ledger. And this is a very common term. And this is what your core accounting system takes care of. The core accounting system really is your general ledger. And that's where all these different things get recorded. So when you're setting up your chart of accounts, you really need to think about, first off, what's important to your company, and second off, what's the bare minimum that you can track that will be helpful to you. So something we see a lot of is big groups of accounts that are broken out into tiny little details that are not important. So for example, travel. You see on a lot of companies' chart of accounts, they'll have travel, airfare, travel hotels, travel meals, travel taxi, travel car rental. I'm not sure why you would need all that detail. Maybe if you are a travel company, that would be important, but generally speaking, having one travel account and then breaking out meals for tax purposes is probably sufficient. So it's good to look at those things and consider what's important. So if you have a previously established chart of accounts, you might want to go through and clean that up once a year. Something I see often is bookkeepers don't know where to put something, so they'll create a new account for it. Well, that's not necessarily the best idea. Okay, so we'll talk about accounting methods now. And so accounting methods are incredibly important to understand what how your books will be kept. So the cash basis is the most basic, and this is what most companies start on. So cash basis is exactly what it sounds like. It's your cash coming in minus your cash going out, and that's your net, right? And so, from that perspective, it's very simple and it's very helpful. However, from the perspective of really understanding when your income is related to and when your expenses are related to, it might not be the best. For example, let's think about insurance. So generally, I pay my insurance for 12 months at a time. And so let's say that bill comes out in April. Well, I'm paying a big lump sum in April, but it's actually attributable to the next 12 months. So I really should spread that expense out over the 12 months so that I can see that it's really related to those individual months. The same thing with income. Some companies take revenue up front for a project that's going to take 6 months, right? And if you do that and you recognize it all when the cash comes in on the cash basis, you're showing this crazy amount of revenue in 1 month, and then the next 6 months you're showing almost no revenue. Well, that doesn't really work either because it's not indicative of what's actually happening in those months. And so you really need to spread it out. And now that's called accrual method of accounting. And the accrual method of accounting is used by most accountants, I would say, and it's definitely the standard, the industry standard. Another buzzword that you probably hear is GAAP accounting, and that's GAAP, and that stands for Generally Accepted Accounting Principles. And GAAP accounting is the standard that's set for CPAs. And that standard basically goes into very big detail on areas that could be gray in terms of recognition of different items. But it's all based on the accrual method of accounting. So if your bank or your investor is asking for GAAP financial statements, you should first talk to a CPA. But second, you can say, well, we do have accrual basis accounting, so it's very similar to GAAP, or it is GAAP. Now, the third method is tax basis. And tax basis accounting is actually pretty terrible in my opinion. Unfortunately, a lot of people end up on the tax basis. They take their QuickBooks file and they send it off to their CPA to do the tax return, and the CPA books a different method of depreciation. The CPA books, expenses that aren't allowed to be deducted. For example, you're never allowed to deduct fines or penalties. You have to limit meals and entertainment to 50%. And there's a for tax reasons. And now the goal of tax accounting and on your tax return for most people is to minimize your tax liability. So you choose methods and you follow the tax law to report the minimum amount of income in each year. Now, if you did that on your books, so your financial statements are coming out showing the minimum amount of income, that's not necessarily the best thing to help grow your business. That does not look good to investors, and that does not look good to the bank. So when you get that file back from your tax accountant, or you get the proposed adjustments from your tax accountant, you might want to take a minute to think about it and say, okay, are these really tax basis accounting, or is this really accrual basis accounting? And generally, it's tax basis accounting. And so when you look at it, you might want to say, okay, no, we're not going to book those adjustments. We're going to keep our books on the accrual basis. A misconception from a lot of people is that your tax return has to match your internal books. That is not true. For tax purposes, you can follow the tax law to the letter of the law, but your books don't necessarily have to match those methods. There are a few exceptions where they do, but those are very specialty items. So what's really important about this? First, you have to identify what method makes the most sense for your business. Are you a very simple sole proprietor? You don't really need to know the finances. Cash basis is fine. As long as you have net positive cash at the end of the day, you're good to go. If that's the case, no problem. And you probably are the one doing the accounting yourself. And you can track the cash basis without a problem. If you decide accrual basis makes sense, maybe you want to get a loan and grow your company, or you want to search for investors, you might want to talk to a bookkeeper, somebody with some training in the accrual basis, or somebody that can train you to do it on that basis. And then you definitely want to talk to an external tax person, or at least a CPA if they're doing your internal books, about taxes every year and make sure that you are following the most appropriate tax methods for your return only. So once you make that decision, you have to figure out what you're going to track, right? And so you're saying, okay, hopefully I've convinced you all that accrual basis is really the direction you want to go. And so you're saying, all right, so what buckets do I actually need in my chart of accounts? And so the first thing to sit down and do is look at your business and look at your expenses. So I would say take your bank statement for the last 6 months and look at what's coming through. What are you spending money on? A lot of companies have typical overhead items: rent, utilities, office expenses. And generally I group into office expenses paper, toner, pens, any supplies that you really need inside of the office to keep it running as a normal office. A lot of people break those out. Again, I'm not really sure the benefit of having a very detailed chart of accounts, but that is a decision that you make. So you have to figure out what's important to you. So then we also have different buckets inside of your chart of accounts. And these chart of accounts can be broken down for your income statement, which I'm sure you guys have heard a lot of. An income statement is just your revenue and your expenses to get to your actual income. And then you have a balance sheet, and your balance sheet is where you report your assets and your liabilities. And those are, the fixed assets. So that's, equipment that you buy, cash that you have in the bank, any other investment accounts that you have or investments in other companies. Then you have your liabilities, which would be, credit cards, loans that you've taken. And then there's equity, which is your ownership in the company. And so that would be on your balance sheet. So on your income statement, which is generally the first thing and the most important thing for smaller businesses to track, you have your revenue. And so your revenue is all the sources of income that you have. So you figure out what are your lines of business and what different revenue accounts do I need. Then you have your cost of goods sold or cost of sales. And that should be all your direct costs. So for every new dollar that you earn in revenue, you will have a direct cost associated with it. And that is what should go into that cost of sales. If you're a service company, a lot of times that's labor. If you're selling a physical good, a lot of times that's the cost of your inventory as you sell it. And then the rest of your expenses go down below in your general and administrative expenses. And all of those come down to a net income number, and that's what's reported on your income statement. So depending on your industry depends on what accounts you specifically put in there and what's important to that specific industry. If you are a service-based company, I highly recommend breaking down your labor so that you know what labor was working on, what project, or if they're direct labor or if they're administrative support. I would put them in 2 different categories. And then also breaking out your owner compensation is generally important, especially if you ever go to sell the company. In due diligence, they'll want that broken out. Okay, so once you decide what's really important, what buckets to have on your chart of accounts, and you have that all set up, you can actually use these numbers to help run your business. And this slide is a picture of different squares that go on your dashboard in Xero so that you can see exactly what you would see if you used this program, which I think is pretty cool. So a couple days ago, I was meeting with one of my clients in their design firm, a service-based industry, and I asked them what was the most important thing for them to track and what were the most important things for them to track. So we talked about it, and he identified 4 items that were really important to their company. 1, he wanted positive cash flow, which I think is incredibly important to almost every industry or every company, especially ones that are trying to grow, right? 2, he said very happy customers is important to them, very important as well. Happy employees, he also said. And then the 4th one he said was to make sure that on each new contract that they won and new project that they did, they were actually making money. And so, from a plain English standpoint, I was like, okay, those are 4 things we can definitely talk about. So first, cash flow. So it's really cool in Xero, you can track both your cash basis accounting and your accrual basis accounting, which makes running reports really seamless and smooth so that you can get a handle on both. So cash flow is a huge, huge issue for a lot of small businesses. And here you can see cash coming in versus cash going out. And so it makes it very visual for you, and you can understand exactly what's going on. So in this example, we're going to assume, December they paid a bunch of expenses early. And then, that was more cash outlay than they had cash coming in. Or, we can also look at this and say, well, December was just a slow month from a revenue standpoint, right? And so, there's a few different ways to look at it and understand exactly what's happening. But you can use that to understand where your cash is going. And there are more detailed reports as well. So also on the cash side of it, we have to think about planning. So we have to say, all right, I'm going to project out for 6 months or a year or 5 years, depending on your industry and your growth projections. And you think about that, and you can put that in and run budgets as well. And that helps with cash flow planning. So you can say, I said earlier, I have to pay my 12 months of insurance in April. So I know that every April it's going to happen. I also have to pay my tax bill in April. And so I have to project out for that. And so all these cash outlays, I know when they're coming, I know the timing of it, and I generally know the dollar amount. So I'm able to project that. Now on the revenue side, I can say, okay, I know I have these projects committed at these dates. I'm going to put that revenue in, and I might be a little bit more conservative and say, I'm only going to put in revenue that's 100% committed. Or you can say, I'm going to follow this growth trajectory that's been occurring for the last 2 years. I feel pretty confident that we'll hit those revenue numbers. And then you can see your cash, and you can understand, okay, yes, that's a profitable month from a cash perspective or not, and you're able to plan for it. And if you do that, you can say a month in advance or 6 months in advance, oh yes, I need to hold on to this much cash or save this for my tax bill, which is coming. So this business performance box is also really cool. And so one thing I said was he said he was concerned that for every new dollar of revenue that he earned, he wanted to make sure they were profitable on it. So we did a couple things for him. First, we said, all right, well, for every new dollar of revenue that you earn, what is the direct expense associated with it? And for him, it ended up being 85 cents. So that's 85%. I apologize. It ended up being 15%. So for every new dollar that he earns, 15 cents of it is going to direct expenses, and 85 cents of it is going to profit. And this is called your gross profit percentage. And this comes up right here, so you can see. And so that's something that you can monitor to keep a pulse on it and say, okay, my fixed costs are getting out of hand, or I'm spending way too much money on these direct costs. I need to cut back. Or, that was a really bad project for me to take because my gross profit percentage is only 60%, let's say. And so we calculated that out and figured out what that percentage needed to be to cover all of his overhead or fixed costs, and not his not his direct costs. Now the other ratios on here are also really helpful from an accounting perspective, and I'm sure you guys can get a little bit more nerdy as you go into this. The current ratio is pretty cool. It's your current assets over your current liabilities. So your current assets, for example, would be cash or unpaid invoices from your customers. And your current liabilities would be your credit card liabilities and unpaid invoices you have from vendors. And what that is saying is, can your current assets cover your current liabilities? So if this is over 1, you're doing fine. If it's less than 1, there might be an issue. So we have your working capital to total assets ratio, which is pretty cool too. So working capital is your current assets minus your current liabilities. So that would be your unpaid invoices from your customers and your cash minus your unpaid invoices to vendors and your credit card liabilities, divided by your total assets. And your total assets would include your fixed assets or your equipment, if you have a building, if you have any investments, other things that would qualify as an asset. And that ratio can let you get a pulse on what your balance sheet looks like, which we discussed earlier as your assets and your liabilities. Now, the other cool thing that you can see on your dashboard in Xero, which really helps run a business, is your bank feeds. And so here, this bank or this account is linked directly to a PayPal account. And so I know a lot of people use PayPal for subscription billing, and then also just to get, normal payments from their customers. And so you can see exactly what's coming in and out and the ebbs and flows of that account. And then it also pulls in the transactional detail, so it makes it a whole lot easier to book all of your transactions. And then you see your invoices owed to you, which is really important as well. Another important thing to look at for small businesses is how quickly your customers are paying. And Xero will show that to you as well. And depending on the industry, depends on the terms. But if you're billing for a service and it's not getting paid for over a month, you might want to talk to that customer and say, hey, you should probably pay us a little quicker, and that might help solve some of your cash flow issues. I always tell my clients to try to collect all of their revenue as quick as possible and pay their bills on the last day possible. And that really helps with cash flow. You'd be surprised. So moving on to a topic that I know is very important to a lot of people, let's talk about payroll. So payroll is probably the biggest area that I see screwed up for companies. And when I talk to people a lot from a tax perspective, they come in with a payroll audit going on, or payroll issues, or forms wrong, or different notices from the IRS. So let's talk about a few ways to avoid that. So the first thing I can say is, if you hire an employee, you need to calculate payroll correctly. Don't just randomly pay them amounts. And a cool way to do that is through Xero. They're not in every state yet, but you can see on this map where they are. And basically, the app lets you calculate the payroll taxes, what should be withheld, and the amounts that should be remitted. It also spits out some pretty nifty reports for you to fill out the payroll forms to submit to the government, both local and federal. And that helps you get the numbers right. Now, it doesn't help you actually pay the tax. You have to do that on your own, unless you outsource the payroll. And I would recommend outsourcing payroll if you have more than a couple employees, or if you don't feel confident that you can make the tax payments timely. Because outsourced payroll companies will go ahead and make those tax deposits for you. I like to use Gusto or Sure Payroll a lot. They're both great companies, and depending on how many employees you have, depends on which one is better priced. The other cool thing is both of those integrate back into Xero seamlessly, so that you have all of those numbers right there. So you run payroll, then you press a button, it all goes straight into Xero, and you can see exactly your payroll expense. So let's talk about the difference between an employee and an independent contractor. And so it all boils down to one thing: control. If you look at the IRS's website, there's 7 or 10 different specific things that they say indicates that somebody is an employee versus an independent contractor. And they say that basically you have to satisfy all of them independently to be an independent contractor. And if you violate one, you're an employee. So first off, a really big important one is having an independent contractor agreement in place. And those agreements should really be reviewed by a lawyer, because it depends on the specific industry, what the person is doing for you and your company. So if you download a blank form from online, it might not be sufficient enough to actually cover you when it comes to this. So in this case, it's totally worth a couple $100s to actually talk to a real lawyer and get an independent contractor agreement written for your specific business. So like I mentioned, control is extremely important. So I was dealing with a company, they're a security company, so they go into people's homes or offices and they install equipment. Well, the company itself was having their people go to these houses. They were giving them t-shirts, they were giving them hats, they were in uniform, they were driving in the company trucks, they were putting themselves out as the company. They were trained internally by the company, which was a big one. And they had to finish the training before they could do it. Now, all of these people were being paid as independent contractors. However, the company maintained control over when they worked, where they worked, how they worked, what they wore, how they were trained. And all of those factors together indicated that they were actually employees. And so, you could end up owing a lot of back taxes and penalties and interest for doing that wrong from the forefront. And they can go back indefinitely at that point. So the IRS has the ability to say, from day one of your business, these people have been employees and you've never paid them as such. And since you never filed a payroll form, there is no statute of limitations, because it only starts when you file the forms and actually report it. So I highly recommend making sure you're doing that right. I think 9 out of 10 times people are employees, and if there's any question, probably default to employee. For independent contractors, if you decide that's the route you want to take, do not control anything about them. Do not give them equipment. Don't tell them when or where to work. They can't, you can't have control over their environment. You have to say, oh, okay, I'm an independent designer. I have an extra project that I can't get to. Here, take the project. I'm going to take 15% off the top of it. You're going to get paid the rest, and you do it on your time, in your way, with your equipment. Go. And that's effectively how you have to treat it. And don't forget that independent contractor agreement is extremely important. All right, next we're going to talk about integrations and industry specifics. So what does that mean, actually? So integrations are these awesome little things that plug into Xero, or they plug into other accounting softwares. And so what ends up happening is you have, a very great core accounting system, but you have companies that do so many diverse things using it. And so from that perspective, each industry has come up with its best in class and best in industry app or application for that, right? And so using that is way better for that company, right? And then having it integrate back into the accounting system, make sure that you can have really good reports seamlessly, which is really awesome. So, there's a few awesome ones on here, like Shopify, for example. If you have a retail store, it's a great point of sale system that also tracks your inventory for you. And then all of that gets integrated directly back into Xero. So you know your sales figures, you know your cost of goods sold, and you know your inventory figures, which is really great information to have. The other thing I like to think about in this is, like I mentioned at the beginning, setting up a custom ecosystem. Now, what does that mean? That means taking a specific company, figuring out what are the bottlenecks here, what doesn't work seamlessly, what needs to be put together to make this package perfect for this company. And so, you sit down and you think about, well, maybe I have a really crappy expense reporting system. I have people taping receipts to paper and submitting it to me, and then I have to sit there and enter them all and then cut them a check, and it's terrible, right? And so a lot of companies use a program called Expensify, which is really cool, and it takes the manual piece of that away. And so all your employees take a picture of their receipt, they type in the description, and then they submit it to you electronically. You say, oh yeah, that's great, approve it, and then it shot over straight into your accounting system, and it's perfect. And then you have all the information. There's no bottleneck, there's no messy paper, and there's nothing for you to keep because it's all archived electronically. There's another program called Nexania that does very similar things. And you can also code credit cards that way as well. If you have somebody with a company credit card and they're a salesperson, let's say, and they're out, spending money all the time doing all this stuff, well, they can have that credit card feed come to their phone, and they can say, that was meals, that was travel, that was advertising, whatever it is. They can attach all the receipts and submit it, and then in Xero, it'll be automatically coded for you, and you don't have to worry about that. So I really encourage all of you to sit down and think about your current financial and accounting systems and where there are bottlenecks. Are you a service company that has trouble tracking revenue? There's a really cool company called ServiceMate, which integrates with Xero as well. You can find in the marketplace that helps with that, and it's been amazing for small businesses like plumbers and electricians that we work with. So really, there's a solution out there for you. Whatever industry you're in, I guarantee somebody's thought of something really awesome to help, and you can find those integrations and find a way to make it work for your company. Additionally, if there is nothing out there, which occasionally does happen, you can program it yourself or hire somebody to do it, because it's all open source code, so that you can find a way to make it integrate for you and work for you, which is a really great way to grow. So another great integration that I use consistently is Bill.com. So let's think about those bottlenecks again. And one of the biggest ones I hear from clients is paying bills. Their assistant forgets to write the check, or they're late on the power bill because they're out of town, or whatever it is. somehow actually writing checks, signing them, and getting them out the door seems to be a very difficult process for most small business owners, and understandably so, because most entrepreneurs are incredibly busy and all over the place, and it's, a manual process. So how do we fix that? Well, Bill.com does. So you can go ahead and forward, PDFs, or you can scan directly to it, and all of your bills go in there. They get coded. You can code them yourself. You can have an accountant do it, or Bill.com even has a service where they'll do it for a couple dollars to code your bills for you. And then it goes through an approval process, and this is critical. So the other issue about this particular accounts payable cycle is that there's a lot of fraud that occurs with it. You have an assistant that you give bank access to, has the ability to sign checks because, it's way easier for you if they just handle it, right? Well, you're not paying that person very much. Sometimes they end up getting overworked, and then they get kind of creative and start paying, their friends and family to do things for the company so that, they're getting reimbursed in a way other than through salary, and that's fraud. So at the end of the day, you really need to have better control over cash. And I would say that's true for a lot of companies. And so Bill.com allows you to have multiple levels of authorization. So you can say in there, it's fine if my assistant pays bills under $500. They can approve them, they can send the check, no problem. But if it's over $500, I want to be able to approve that and make sure it's a real bill before it gets paid. And the other cool thing about Bill.com is you can control who can pay it. Whether they can pay it or you can, or your accountant if you have somebody in there helping you. And you can go in, and we make it a challenge for our clients to tell us the coolest places that they've paid bills. One of them was a fishing boat in Alaska. Apparently he had really good cell service. I don't really know how, but he did. And then we had somebody on a beach in Hawaii paying bills. So it's really cool. They'll mail a check for you, or do a direct transfer if they're in the Bill.com network, which is always growing. So I would highly recommend checking it out. And it integrates with a bunch of different accounting systems as well. So step 5, growth. And this is my favorite part, is how do you really grow your business using your finances? So let's wrap up a little bit. We've talked about how to build a good chart of accounts, how to think about what is important to your business and what you should be tracking, what is a direct cost and an indirect cost, what's important to you versus what's important to a bank, and how do you use your financial accounting information. How do you identify ratios or identify specific things that'll give you a pulse of your company and how to grow? And so once you've done that, you really need to figure out when and where you need help. And so I say that because, CPAs and accountants in general are trained to do this, right? And so there's different levels, and I think there's a lot of confusion for small businesses as to what qualifies as a CPA versus a tax accountant versus a bookkeeper. So a bookkeeper is your basic level, and a bookkeeper can have a degree, cannot have a degree, can have certifications from software, cannot have certifications. It's not monitored at all. Anybody can really hold themselves out as a bookkeeper if they have any experience entering numbers for a company's accounting. And so at the very core of that, I would say, a good bookkeeper would have at least enough experience to know what's going on, and that you should vet them really well. And I know Xero has a really good network of partners that are bookkeepers and partners that are accountants that have been pretty well vetted. And you can see from the listing how big they are, how many clients they have. And the more clients they have, the more legitimate you can probably assume they are. And so I would highly recommend looking at that. And the other thing I would say is you should always interview at least 3 different service providers to figure out what's best for you, because it's not only about who can do the work or who can do it the cheapest. It's about who can do it and understand your company and help you, and that's what's really important. So after your bookkeeper level, you have accountant. And generally an accountant would have a degree if they're holding themselves out, and then they'll go into a company as a staff accountant and then generally get up to controller. And a controller really does control all the finances and accounting for that company. And then above that, you have a CPA. And a CPA is a certified public accountant. CPAs don't just do taxes. In fact, that's a very small amount of what CPAs do. And that is a certification where you have to go through a bunch of schooling. Generally, it's a master's degree, sometimes just a bachelor's. Plus, you have to pass a bunch of tests, and you have to keep up on education every year and to maintain that license, and it's registered with a state board. So you can look that up online. So there are a few CPA firms like Rock that does outsourced accounting for their clients. A lot of CPA firms will only do end of year reviews or tax returns. So you do have to figure out exactly what you need and what you want. If you have a bookkeeper in-house, I would recommend having an external CPA do your taxes so that you can have an extra set of eyes on it every year. So there's some super cool educational resources. So if you guys want to learn more about Xero and you decide, okay, well, I'm going to do it personally for a while and then I'm going to hire somebody, well, Xero U is super cool. It gives you a bunch of different insights into how to do things and why to do them and what's important to small businesses. And I direct clients here all the time to look at stuff. And then Xero TV, has a lot of really interesting short videos about what's going on with Xero, what's going on with the integrations, and the whole ecosystem in general. So thank you guys so much. It was really fun talking to you about accounting.
And thank you so much, Liz, for what was quite an illuminating conversation today about all of the different things that are involved in accounting and how to keep track of what's important and also where to go for additional resources. And for those of you watching this video, I also did want to let you know that we do have a free trial available for any of you who aren't currently using Xero. If you want to log in and connect your bank accounts and play around without any kind of commitment, you can check out that free trial button at the top right of the Xero homepage. And there's also a demo company that's preloaded with all kinds of company details so that you can play around as if it's a real company and try out some of the different features without worrying about breaking anything. And we also do have that link to view plans and pricing, and depending on when you are watching this video, we may have some special promotions on, so do check that out as well. And again, I just really want to thank Liz for taking the time today, and thank all of you also for making sure that you're learning and continuing on your journey with accounting and making sure that you have all the tools that you need to be able to make some powerful business decisions. So thanks so much for joining us. And if you want to get in touch with Liz, her contact details are on the screen here. Otherwise, thank you so much, and we'll see you in your next course at Xero U.